Hello, Finance for Life fans. My name is Arthur Vatal, and we are back with another episode of the Finance for Life podcast. I am a high school student with an interest in the financial field and finance literacy. I started this podcast to help people gain financial knowledge and help people around the world grasp a better understanding of the financial field. Here with me today is Ms. Bagri, and she is an investor at Centana Growth Partners, a growth equity firm that invests in the future of finance. Prior to Centana, she worked at Morgan Stanley in their investment banking division, advising technology companies on a variety of transactions and also working on project development and strategic projects. Now, she works as a venture capitalist at Centana. Before we begin, I would like to thank Ms. Bagri for being on this podcast and giving up her time and expertise. Now I will pass it on to Ms. Bagri for introduce yourself and your field of work, and can you describe a little bit of what you do in that field?
Yeah, for sure. Thanks so much for having me. So my name's Avantika, and yeah, I'm an investor at Centana Growth Partners. We focus on investing in fintech, financial services, and the related enterprise SaaS ecosystem. And we're focused on kind of the early growth stage. So really after startups have found product market fit, they kind of have a go-to-market motion and sales team that's really, working for them, but they kind of just need more capital to further accelerate that growth. So it ends up becoming generally like Series A through C startups is where we invest.
Got it. And again, that question is really just for, people that are watching the podcast, people that might be intrigued by, investing, being a venture capitalist. So that's just to help them, figure out whether they want to go into that field. And the second thing I would want to ask is, what really sparked your interest in joining this field? And can you share a little backstory of how you got to where you are now?
Yeah, for sure. So I would say it started all the way back in college. So I went to the University of Michigan for undergrad. I was in their Ross School of Business, and one of the programs Ross had was called the Zell Lurie Fund. And essentially, what we did over there, it was a 2-year program. A professor essentially selected a group of 20 students that he really wanted to mentor and really give a real world experience of what investing means. So I was selected to be part of that for my junior and senior year. And what we did was we actually analyzed super early stage, so pre-seed stage startups when sometimes it was just an idea or there was no revenue really being generated. But what that class or, kind of club really did for me was it made me understand kind of what it means to think like an investor. So we kind of did everything from doing market work, understanding what the addressable market for this industry really looked like, trying to understand what exact product are they developing, is there demand for such a product, really spending more time with the team, looking at competition, etc. So that's what kind of, really sparked my interest in being an investor. And I was like, oh wow, people actually get to do this full time as a career, which was really cool. But what I did in terms of starting off my career is I went to Morgan Stanley in investment banking, as I feel like a lot of students who pursue business for undergrad generally end up going into investment banking or consulting. Those aren't the only two fields. I didn't even know when I was in college that you could go into investing directly as well. So I'm happy to speak more on that. But yeah, I went into investment banking. I spent some time in Morgan Stanley's technology investment banking group, really kind of learning more about how businesses that are way later stage, the transactions they work on, learning about valuation, learning about different industries, etc. So that was definitely helpful in terms of, developing some core financial skills, and just learning more about the market. And then, a lot of people who go into investment banking then kind of recruit to go into the buy side. And I was kind of clear that I didn't really want to go into super late stage private equity. At the same time, didn't feel like, super early stage pre-seed investing as someone who's never really started a company would be the best place for me to start. So I decided that I'd start kind of at that growth stage where you have more financials to analyze, understand, but at the same time, you really get to, see a ton of really cool, new, interesting companies and what they're building out. So that's essentially how I decided on Centana, given their experience in technology and focus in technology. And then when I was in banking, I actually worked on the Toast IPO. If you guys are kind of familiar, when you go into a restaurant and generally when you're paying, Toast is sometimes what the restaurants are using. And that was my first exposure to fintech and payments. So as a result, I decided Centana would be a great fit given they focus on fintech as well.
Yeah, nice. So one thing that like kind of intrigued me was you mentioned there's like multiple stages, like the pre-seed stage, the growth stage. So can you just elaborate a little more on that and like honestly, like which one do you like the most?
Yeah, for sure. So I would say overall, I kind of bucket it into three different stages. So one is what you would maybe call like true venture capital, like the super early stage, pre-seed, seed. And those are generally stages when, companies are either just starting out, they kind of only have an idea or they have, kind of some traction, but they don't really fully have product market fit. Probably things are still changing in terms of what they really want to build and develop. So that's one stage. Then you have kind of the middle stage, which is what we call growth equity. And it kind of really varies. You have firms that are focused more on the early side of growth equity, like Centana, right after companies have product market fit, but they're not too big. And then you also have companies that do kind of later stage growth equity, where firms are kind of much bigger, but they still need more capital to continue to grow. So that's kind of, I would say, like growth stage investing. And then you have on the other end of the spectrum, private equity, which is kind of super late stage buyouts. And what that means is that, if you're a private equity investor, you're really looking for companies that you want to purchase, entirely either in whole or a majority stake, where you're really going to be the one after you've made that purchase, kind of making the decisions on how do you want to cut costs? Are there new products you want to add in? How do you want to restructure the team, etc. So I would say that's kind of a lot more involved in terms of role wise, like a lot more financial modeling that goes into that. Whereas on the earlier stages, I would say role wise, and we can go into that deeper as well, but like on the earlier stages, role wise, you're still doing some financial modeling, especially on the growth stage, probably not as much on the super early venture side. But with the venture and growth investing roles, I would say you're probably spending more time kind of thinking about different industries, different markets, what's going to happen in the future, and also spending a lot of time, even as kind of a junior person on the team, getting to talk to a lot of founders, given
Mm,
that they're kind of early in building out their company.
got it. So would you say that the pre-stage is more like, I guess, risky because you don't know really how the company like is working yet. You don't have the product market fit, all that stuff.
Yes, for sure. I would say, and the thing becomes you also kind of end up getting compensated for that risk. So different funds at different structures kind of work different ways. So at the super early stage, the pre-seed seed stage, if your investors investing in those categories, what you generally expect is that, you're going to make a bunch of different investments in like a sector that you're really interested in, kind of, believe is going to really grow in the future. And what ends up happening is that, majority of the investments you make, either the companies, end up not existing anymore, and kind of your investment goes to zero, but then you have a few companies that kind of give you an outsized outcome and really kind of return all of the capital you've invested across various different startups. So also at the earlier stage, you're generally investing maybe a smaller check, and then you work it out with the founders as to like how much equity you really want to take for the risk that you're taking. And then the later stage that you get, I would say, like, for growth equity, you're generally trying to get maybe a 3 to 5x return for the companies that
Mhm.
you're investing in. And then in private equity, generally what I've seen is like a 3x return is seen reasonable. So
Yeah.
different risk profiles for sure at like different stages, which also ends up causing kind of different approaches as to like if you want to do a ton of different investments and you hope that a few really, do super well, that's kind of more venture style investing. And then you have growth, which kind of varies, and then private equity, where it's like you're making fewer investments, but you're kind of betting on like they're going to give you somewhat consistent returns.
Okay. So one thing I wanted to ask, this kind of relates to what we already talked about, but can you explain what a venture capitalist really is in like simpler terms for those who might not be familiar and like what you do on a day-to-day basis?
Yeah, for sure. So a venture capitalist or any investor is really someone that is investing money in return for a share of the company that they're investing in. So for example, with Centana, we have a bunch of kind of other partners that give us their money to invest. We go out and try to find interesting startups that we think are going to do well in the future, continue to grow, and will kind of ultimately exit, whether that's being acquired or going public through an IPO and being listed on the stock exchange. So we go out and try to find really interesting companies, talk to the founders, and kind of give them terms of being like, hey, we really like your company, we want to invest X million in your company for like X percentage of equity. And really what you're hoping is that the money that you're giving the company at a certain valuation, as the company continues to grow, other people see that the company's worth a lot more than when you invested in it. So
Yeah.
then later on, when you sell your stake, you're getting more money than you put in. So that's really all investing is. And then in terms of my role, I would say this again varies depending on the stage that you invest at, and the fund that you're at. But in terms of my role, I would say it's kind of split mostly between doing due diligence on deals and then trying to source new deals and a little bit of portfolio work. So I'd say across all the different stages of investing, those are essentially the three different areas that an individual who's an investor would probably be spending time in. And it really just varies depending on the firm that you're in and the stage you're investing. And just to go a little bit more into like what does due diligence for a company look like. So what it really means is, when you're looking at a company you want to invest in, especially at the growth stage, they typically have a few years of financial data, of customer level data. So what I do is I kind of go in and analyze, first kind of looking high level at their income statement to see how has their revenue been growing, where are their costs, are they profitable or not? We don't care as much about that in terms of the point in time we invest in, but really try to just understand, are they growing efficiently? If they're spending
Yeah.
X billion, are they generating more revenue than that? So kind of high level looking at those metrics. And then you spend a little bit of time going deeper into kind of customer level details to better understand, how much churn do they have? How much retention do they have? How effective is their marketing spend in terms of how much are they spending and how much revenue are they generating? So I'd say that's kind of the high level due diligence we do. And then we also do due diligence on the market side. So if the financials kind of pan out, we'll do expert calls, where there's these expert networks that you can contact and tell them kind of what area you're looking at and what you want to learn more about. And they will find you industry experts or people who have spent time in this space for you to talk to. So we basically do like 30-minute to 1 hour calls with these people, trying to better understand, hey, like, is this a product that people actually really like? How does it compare to their competitors? Is it a market that we think is growing? Is the solution kind of structured in a way that'll be able to kind of continue to grow and generate more demand? So that's kind of our second phase of diligence. And then I would say the third phase, if we're really, really interested in kind of giving terms, is focusing more on the valuation. So looking at what are other companies in a similar sector valued at, trying to do some like modeling to understand what our returns look like, under various different structures as well. So I would say that's kind of on the due diligence side. Then a big portion of my time, and I would say kind of any growth or like venture investor, is spent trying to find really interesting companies, and what we call that is essentially sourcing. So you can do sourcing in a few different ways. I like to do it thematically, so like find a few different themes I'm really interested in, I think are going to do well, and kind of dive deep to understand what solutions are there, what are they building that's different. It is a lot of like cold outreaching to founders as well. So I'd say like any investor is also like a salesperson. Like you're really just trying to reach out, show your value, get people, on a Zoom so that you can better understand what they're building. I go to a lot of conferences as well, which is really cool. So I would say it's like a nice mix of the quantitative and qualitative. And then there's also like portfolio company work that kind of varies from fund to fund as well in terms of like how involved you are with your portfolio companies.
Mhm.
I'm not like personally super involved in like the day-to-day operations of portfolio companies. Generally, when you're like an earlier stage investor, you'll probably be more involved. And then if you're like a private equity investor and you've bought the company, you'll be more involved. But yeah, I'd say like those are kind of the three general areas that an investor spends time in. And if someone's looking to go into this field, I would say to like definitely talk to a bunch of different people and kind of self-reflect to understand, what do you think you'll enjoy spending more time in? Is it like really just doing more of the financial analysis, or like do you really also want to be going out talking to founders, going to conferences and doing more of that qualitative work too?
Yeah, no, that was all really interesting actually. One thing is like, so when you first look at a startup or a company, so like you look at their product, you look at their revenue, and then you really just look at and like try to see if they're gonna grow, if they're gonna be like, I guess, a good company in the future. And then so that's how you make the investments, and that's how you like, hop on call with them, figure out if they're like, figure out how their company is working, and then you see if you're gonna invest. And then so one thing I just wanted to ask was you mentioned about like seeing if what market is good. So what market do you think is good right now? Do you think it's more like AI and technology or, another field?
Yeah, I would say like I mean AI for sure. I feel like we're definitely gonna see probably like 5 to 10 years down the line. It's kind of I guess like maybe a little bit similar to the dot-com bubble, where you have a good number of companies that are gonna continue to succeed and do really well and become really big, and probably a good number that are just gonna not exist anymore. So I would
Mhm.
say like AI is in a space that we specifically have been spending a lot of time in just because it is newer. I feel like, venture investors who invest earlier stage are probably definitely spending a lot more time over there. We end up spending time in like industries that we feel like are a little bit more mature. So I would say like a few areas that I've been spending some time in that I'm interested in. One is overall like age tech, so anything to do with the aging population. So I read like quite a few statistics, and I think there's articles out there basically explaining that I think it's around 2034 the number of older adults in the US are going to be more than the number of children for the first time ever. So I would say like I think that trends like that, and it's a lot of reading as well in this industry, like whether you get your news from like actual news articles or like what people are posting on Instagram or TikTok. There's just a lot of trends kind of out there that spark your interest. So I would
Yeah.
say that was one that kind of sparked my interest of, hey, because the aging population is going to continue to grow, especially in the US, I think there's going to be a good number of startups that will be really successful in the next few years that come about specifically catering to the aging population. There's also statistics on like how 1 in 5 senior individuals in the US are victims to fraud or scams. So
Oh,
I feel
wow.
like there's probably, a lot of solutions that are coming about
Yeah.
specifically for like that use case. So that's one area I've been spending some time in. Another area I've spent a little bit of time in is like pet tech. So like I have a mini golden doodle, so it kind of just I was like, oh, like let me go and see what kind of what people are building in this space. And what I kind of realized is that there's at least there's not a ton of companies that reach the growth stage where like we invest. But what I did find is that with this like pet tech environment, you either have these huge like legacy players that have been in the space for a really long time, or you have a lot of like newer players that have come about, and like a lot of them get acquired in like 2 to 3 years. So I would say for like an earlier stage investor, it's probably like a super interesting space to be. And then there's hopefully, I think there's like a few companies that are reaching that growth stage and like aren't getting bought out and are continuing to grow. So that's
Mhm.
an area that like, I'm personally interested in, will keep a little bit of a tab on, but at least found that, there aren't a ton of immediately actionable opportunities for like our fund over there.
Nice, nice. So a lot of it's based on interest, and
For
I
sure.
bet there's of course a lot of research that goes into it. And one thing that I just thought of was that, all of this kind of reminds me of the stock market, except with companies versus a single stock. because I do investing in the stock market, and then so I research, I look at revenue, quarter three revenue, stuff like that before I invest in a stock. So then this kind of reminds me of that, about like how you guys look at products, hop on Zoom calls and then decide whether you want to invest in the company. And one thing that, kind of for the viewers is, for someone interested in like a career in growth equity or venture capital investing, what skills or like qualifications are important? Like, how do you get chosen out of those 20 people by your professor?
Yes, yeah, for sure. So I would say in terms of like being able to develop a career as an investor and go into that full time, a lot of it does start from like what you do in college.
Mhm.
I would say there's a few different things in terms of paths to like get into the different buckets of investing that I mentioned. If we start off, I'll start off with like private equity, which is kind of the most traditional. They have like a very set way of you to get into private equity. It's generally like, you go to an you get an undergraduate degree. While you're an undergrad, you'll probably do an internship or two, whether that's in private equity or investment banking. And then in terms of like getting into private equity, I feel like now there's quite a few programs that you can kind of get directly in as an analyst out of undergrad, or you go into investment banking, do that for a year or two, and then get recruited into a private equity fund. So I would say if like that's the path someone's interested in, definitely focus on like kind of taking few like business classes, being overall familiar with how financial statements work, etc. There's a lot of guides out there that explain that as well in terms of what's typically asked in interviews. And then kind of, focus on getting an internship in investment banking or private equity. And that recruiting starts super early,
Yeah.
unfortunately, like when you're in college. So I'd say like that's one path. For like growth and venture, it's a little bit more flexible. I'd say like especially for super early stage on the venture side, I've seen a lot of people like, you can of course get through there by going into like consulting or investment banking. Same for private equity, actually, you can do consulting too. They just tend to recruit a lot more from banking. But on the venture side, I would say, you can go down those two paths, or you can join an early stage startup. You have kind of a significant like product role, etc. over there. If the startup does well, you can kind of end up moving into venture after that. And then I would say for the growth stage, again, it kind of varies. I'd say the most traditional path is probably going into investment banking or consulting and then getting into growth. But I'd say there's actually a lot more opportunities now that I've been seeing for undergraduate students where you can start to show your interest in being an investor. So like one would be joining any like investment clubs. You can generally join those as like a freshman or a sophomore. I'd say like showing that interest early on, all the companies really look for is like, hey, like, are you truly interested in this? And the best way to show that is like being involved in clubs, I would say, is one. And then the second thing that I've seen more of recently, and like that I either like didn't know existed or didn't exist when I was back in college, is these like scout programs. So you can essentially be a scout for one of these venture funds, and kind of all your responsibility is over there is you get to like, go out, meet founders or like interesting companies and kind of pitch the fund that you're a scout for, being like, hey, I'd love to learn more. And it's essentially like a great way to kind of get that sourcing experience and show that you're actually interested in specific industries. You can talk to founders, you can kind of like surface interesting companies to the fund that you're a scout for. So I would say like definitely look for like scout opportunities as well. And then there's a few other kind of clubs or programs. There's one I came across called Girls into VC, which is really focused on like women in college that want to get into venture capital. So if you can kind of, either start a chapter for that organization on your club or join it, I think like things like that definitely will show demonstrated interest and just make it easier for you when you talk on interviews as to like why this
Yeah.
career you want to pursue.
Yeah, nice. I'm definitely going to use all of this information because I'm about to go into college too. And one thing these podcasts have really helped me with was, at first I wanted to be an investment banker, but now I'm kind of leaning towards being a venture capitalist.
Yes, yes.
But one thing I was wondering was, there's lots of risk in venture capitalists. It's kind of like stocks again, like, doing penny stocks. It's one of the most riskiest things. So one question I had was, how do you manage the risk of investment with like the potential for reward, especially in like high risk sectors?
Yeah, I would say in terms of the approach that we take, and I think every fund does it differently, there's different ways that you can really structure an investment. So like when you are investing in a company, you can either kind of have this pure exchange of like, hey, we'll give you this much money and like you give us this much equity. And then there's different kind of structures that you can add on to that. So like when you come in as an investor at a later stage, there's one structure where you can tell the founder that, hey, in case something happens, like we want our money back first before any other investors. And that's kind of pretty typical in terms of like when you come in like later stage as an investor, you oftentimes can structure the investment so that you get your money back first. Like, it'll just be the 1x return. So whatever you put in is what you're getting back in like worst case scenarios, unless the company has no money at all, then like that's a risk that you kind of just have to take. And that's why kind of a lot of the modeling and market work is really important. You can also structure investments in a way where like, you kind of incentivize the founder being like, hey, after we get a 3x return, we'll give you an outsized return where like you can take more money than like we would have under a different structure. So I would say there's like different structures you can really play around. You can also have kind of like another structure where if and like the founder understands as well that like, hey, this is like a riskier investment, or like we're coming in at a point where there's like still some doubts or things going on in the market, but we think you guys will be able to overcome them, we really want to invest. You can kind of structure it in a way where it's like, hey, we want to have kind of 2x of our money back first before like paying out anyone else. So it's definitely a negotiation, but there's different kind of structures that you can implement to be able to minimize that risk. But yeah.
Nice. So it's all about like negotiating, making deals, doing research before. Nice.
Yes, for sure.
So the last question that I had was, kind of for the people watching that might be in middle school, high school, is where do you see the future of venture capitalism headed, and like what will the industry look like in about 10 years?
Yeah, that's a big question. I'm not sure what it'll look like in 10 years. I mean, I hope that there's kind of more diversity in terms of the people that are investing and the companies being invested in. I'd say like the industry is definitely kind of very dominated by white men today. So I'd say like I'd love to see kind of, more people of color in the industry, also being able to like invest in more diverse founders. I think, women end up getting a very, very, very small portion of like all the capital that's invested in the industry. So, and I think there's been like a ton of great progress around like there's a lot more specific funds starting that like only invest in minorities or like, individuals of color or women. So I think over time we'll hopefully be able to see like a little bit more of a balance around who we invest in and like who's making those investment decisions, which will be really nice. And then I think probably also more like just as an asset class, I'd say venture capital today in terms of the people that get to invest in venture capital funds or like startups that like for the stock market, for example, you or me can very easily just open up kind of an E-Trade account and go and invest. That's become a lot more democratized than it was probably like 50 years ago, when it was like only people working at big banks that were really kind of making those investments. I think hopefully we see something similar in venture capital as well, and you are starting to see it today where like people like me and you, if we really wanted to, we can go and invest in startups through like various different platforms, or like become part of a fund that really focuses on like angel investments, and like they surface more interesting companies to you that you can choose to invest in when they're still super early and private. So I hope that like over time it becomes easier for like people who aren't maybe like in the top 1% to like be able to invest in an asset class like venture capital, where sure it's high risk but also there's like much higher reward. So yeah.
Nice. Yeah, I know. More diversification, more that balance is definitely much better. And so thank you, Miss Bagri, for your valuable time, sharing your knowledge. I myself learned so much from this podcast. I can't imagine how much this will help all the viewers around the world, especially when you said like, the three stages, the pre-growth, the pre-stage, the growth stage, and the private equity stage. That was really interesting to me. I'm sure it was interesting to a lot of people. And like I said before, it's kind of shifting me towards venture capitalism. And so this will definitely help out my podcast, all the people willing to gain literacy in the financial world. So I really appreciate everything. I hope you guys have learned a lot from this podcast. And thank you so much again, Miss Bagri, for your time. And thank you guys and subscribe for more.
Awesome. Thank you so much for having me.